So the topic of this pencast for Chapter 4, Part 3 is going to be closing entries and the current ratio. Closing entries are made as journal entries at the end of the month, dated the last day of the month. Why would we need closing entries, and what accounts would we close? Recall that accrual basis accounting divides a business into artificial time periods and then measures the results of operations for that period of time. We want to know what revenue is for, in our case, the month of November. We want to know what expenses are, in our case, for the month of November, so that when we look at net income, it's cause and effect, and it's done on the accrual basis of accounting, not the cash basis. If that's going to be the case, then on November 1st, revenue must start with a zero balance, and expenses must start with a zero balance. And on December 1st, same thing. They must be set back to zero so that we can measure income for December. This process of resetting accounts to zero is called the closing process. And in the closing process, we make closing entries. What accounts get closed? Well, you can see that revenue will, because it needs to start at zero. And you can see that expenses will, because they need to start at zero. And one that might not be as intuitive is draws. These accounts are the accounts that we make closing entries for, and they're also known as temporary accounts, and they get that name because their balances are always being reset to zero. You never reset your balance sheet accounts. You get to keep your cash at your accounts receivable, you get to keep your cash, your accounts receivable, any buildings, and unfortunately any debt you might have. So those are called permanent accounts. We only close temporary accounts. There are only 4 closing entries that we need to master, so it's pretty easy. And all of those are taken directly off the adjusted trial balance, so even easier. You don't have to calculate anything. They come right off the adjusted trial balance. I brought forward a picture of our accounting cycle. I want to point out to you we're now at this point, and we need to close our revenue, expense, and draws accounts. We're going to introduce a new account to you, and the new account is called Income Summary. Income Summary is the most temporary of all accounts, and it exists only long enough to facilitate the closing process. What it allows us to do is exactly what its name says. It has you summarize income. So we'll use this account while we make our 4 closing entries that are made at the last of the accounting cycle, always dated the last day of the month. So, are you ready to learn the 4 closing entries? The first one would be to close revenue into an account called Income Summary, which we just discussed. And after you make this entry, you now have an account that exists with a balance in it called Income Summary, and you've transferred revenue into it. The second closing entry you make is to close expense accounts. And expense accounts are closed into, you've got it, Income Summary. So if you close your revenue into Income Summary and you close your expenses into Income Summary, you now have net income sitting in an account called Income Summary. Your third closing entry closes Income Summary. See how short-lived it is? It closes it into capital, because net income belongs to the owner. And finally, just as is shown on the statement of changes of owner's equity, net income gets transferred into it. When you do this, you'll probably debit it if it's income, credit it if it's it's a loss. And it leaves this account at a zero balance, so it exists only long enough to facilitate the closing process. The last closing entry then closes the draws or withdrawals account into capital. And after you have posted these 4 closing entries, capital now agrees with the statement of changes in owner's equity. You have a capital account. It has a beginning balance. You have added to it net income. You have removed from it any draws the owner might have taken out. And then it's its ending balance. Those are exactly the things that happen on the statement of changes in owner's equity. We're now going to make those 4 closing entries using the adjusted trial balance that we created on our page 1. Are you ready? Let me flip the page here. Noise. So 4 closing entries. 1, close the revenue accounts into income summary. 2, close expense accounts into income summary. I guess I shouldn't abbreviate, huh? Close revenue into income summary. Close expenses into income summary. Then close income summary into capital. And then close draws into capital. At that point, you're done with the accounting cycle. In our example, we had 1 revenue account in the amount of $11,000. So, since it has a credit balance, can you hear my dogs? Yeah, somebody knocked on the door. Close revenue. Revenue has a debit balance on the adjusted trial balance. Revenue has a credit balance on the adjusted trial balance, so we'll debit it and we'll put it in income summary. And you can see revenue just went to 0. And income summary now exists and it has revenue in it. Income summary has $11,000. I transferred it out of the revenue account and into income summary. Let's close our expense accounts. You recall expense accounts have debit balances, so we're going to credit them. And we'll end up debiting income summary for their total. We have to list them one at a time. We have depreciation expense. It had $1,500 in it, so we'll credit it. That will go to 0. We have rent expense. Rent expense has $5,000 in it. We will credit it and it will go to 0. Supplies expense. It was kind of high, wasn't it? $3,600. So we'll credit it and that will go to 0. And that transfers $10,100 worth of expenses into income summary. Income summary has revenue in it and expenses taken out of it, and now it sits at the amount of net income. The third closing entry is going to transfer that to the capital account. Notice it has a credit balance, so I'm going to debit income summary because I want to 0 it. So there's my $900, and I'll transfer that to the owner. And they now get credit for net income, and net income, that amount comes out of income summary and it takes it to 0. That is the most temporary accounts. And finally we need one more entry, and that's to close draws. Capital goes down when the owner draws out money. Our owner took out $2,000. So we'll debit the capital account and we'll credit draws. That will take draws to 0. What happened to our capital account? Well, if you'll recall, we have a capital account that has a beginning balance of $5,000. It goes up for net income, down for draws, and an ending balance of $3,900, which agrees with the statement of changes in owner's equity. We're now done with our closing entries. We closed revenue, we closed expenses, we closed income summary, and we closed draws. For some reason, students seem to have a hard time with closing entries on the final exam, so take a little time and make sure you understand the concept. Finally, we have one more thing I want to cover, and that's ratio. We want to cover the current ratio. We've done closing entries above, so let's cover our one ratio for the chapter. When we started studying in chapter 1, we said we were going to learn how to do financial statements and financial reporting for businesses. We were going to pass those to outsiders, people external to the organization, and they were going to use those for decision making. Did they want to invest in us or not? One of the ways owners use our financial statements is to do ratio analysis. And in the course of the next 17 chapters, you're going to learn several ratios. This one is called the current ratio, and it looks at the relationship between current assets and current liabilities. All ratios take a couple of numbers off financial statements and compare them to each other. What this ratio will tell us is that for every dollar we have in current liabilities, how much do we have in current assets to cover them? Our business has great current ratio. We have current assets in the amount of $7,500 and current liabilities in the amount of $600. If you divide that out, 7,500, you find out our current ratio is 12.5. That's not very realistic, I have to tell you. I could have made up a better example. A target is somewhere between 1.5 and 2, so that for every dollar you have in current liabilities, you have $1.50 to $2 in current assets. We like this to be like that because you can't pay bills with inventory and accounts receivable, so we don't want it to be 1-to-1. That would make you very tight. Indeed. One way you can get a feel for how businesses do it is by looking at a trend of what its current ratio is during over a period of time. Maybe 2011, your current ratio was 2-to-1. In 2012, using realistic numbers now, it's 1.75 to 1. 2013, it's 1.5. You could say this trend is to be less liquid and less able to pay your bills as they can do. You can see that a ratio taken by itself, a period of time is just a number, but when compared over several periods, you can see trends. You can also compare it to the industry you're in. Industries always publish ratios that are popular for them. If our particular industry showed in 2011 the current ratio was 1.5, and then it dropped to 1.3 for the industry, and then it recovered and was back up at 1.5, we would say, although we're slightly less liquid, the industry is as a whole, and so we're probably exactly where we should be. In each chapter we'll look at some more ratios where you can pass information and they can analyze it for external users and decide how we're doing. This measure looked at liquidity, how able we were to pay our bills as they come due in the next year. Thanks for joining me. This completes our review of Chapter 4.